What is going on, my friends? Ryan Williams here, back with another one, and in today's video we will be doing a deep dive into a certain dividend king, one that is currently sitting on my watch list and that as of late has been plummeting in share price. At any rate, we are going to run through this company's share price performance, its current valuation, we'll take a look at its financials and dividend stats, and we'll also be using the intrinsic value calculator on version 4.0 of my dividend portfolio tracking spreadsheet, which should help us gauge whether or not right now is a good time to buy this company. So that's what we have coming up first, and then later on in this video we will be getting into a little bit of a Q&A where I'll be answering some of your guys' questions, like what combination of factors I consider when buying a new dividend stock, and how to accurately identify the causes of earnings per share growth when looking at a particular stock. Anyway, before we get rocking and rolling, if you guys are excited to talk about some awesome dividend stocks today, go ahead and give this video a big thumbs up. And if you're interested in learning more about dividend stocks, then I'd ask you to consider subscribing to my channel. On this channel, we strictly talk about dividend stocks, and every single week you can expect 2 videos from me on the topic of dividend stocks, most of which are analyses and updates, as well as inside looks into my own dividend stock portfolio. So if those are things you'd at all be interested in seeing more of, go ahead and hit that subscribe button for me. Anyway, thank you so much for doing that. And now, without further ado, let's get into it. All right, guys, now the company whose stock we are going to be talking about today is Target, ticker symbol TGT. And you guys probably saw me talk about this in my best dividend stocks to buy in January 2022 video. This was one of my selections for that. But for today's video, I'd like to dive a little bit deeper than we did in that video and talk about Target a little bit more in depth. Starting with its share price performance, Target has actually had a pretty good year. It's up 33.37% in the last 365 days. Zooming in a little bit closer, in the last 6 months, it's actually down about 4%. And then in the last month, guys, it's down just under 5%. And actually, it was down even more. It was down, it's currently sitting at $232.42 per share, but it was down close to about $215 per share. So just in the last like week and a half or so, it's gained another 15-ish bucks per share at the time of this recording. And probably by the time you're watching this video, it has gained even more. So Target is definitely making its way back up. But as you guys can see, it still has some room to continue growing up. At its recent highest, guys, which looks like it was at mid-November, it was sitting at about $266 per share. So it still has some upside potential of about, I would say, over 10%, right? Maybe 15% to reach its recent high of 266.39. According to this right here, the 52-week range is 268.98. So still has about 16% to go before it reaches that point. So like I said, still a little bit of upside potential for Target. Now let's scroll down, guys, and take a look and see what the bulls are saying. So the first one here says, Target's recent stock slide, despite another quarter of beating expectations, gives investors a rare opportunity to purchase shares in this dominant retailer at a discount. So I would say technically, yes, it is a small discount, guys. It's down almost 5% in the last month. It's down 4% in the last 6 months. But still, guys, as far as valuation, which we'll take more of a look at in just a moment, I do believe it has some room to continue coming down. And I'll explain more on that later. You'll definitely get a better sense of that once we go through the intrinsic value calculator. Now, scrolling down, guys, I want to read what the second bull has to say. So, Target stock price offers an attractive entry point for a company with solid business model and strong dividend growth as inflationary pressures and supply chain pressures ease. So this bull right here also has Target at an attractive stock price. And once again, it's not terrible. Okay, the PE ratio is still under 20, but I think it could be better. I think it could be about 40 bucks better, frankly. But anyway, guys, enough on that. Let's now jump over and dive a little bit deeper into the valuation. And Seeking Alpha seems to think that Target's not at the best valuation either. They give it an overall valuation grade of a D+, which is not passing. Anyway, scrolling down, taking a look, we just saw the PE ratio here, 17.5, which actually is a little bit higher than this company's 5-year average PE ratio. So compared to where this company historically has sat in the last 5 years, it is a little bit more pricey. And then also compared to the sector median, PE ratio is almost 20% higher than the sector median right here. So both of these indicate, just based on the PE ratio, Target's not as affordable as it was, and I think as it could be. Scrolling down, guys, we can see the price to book on Target is extremely high. Okay, 8 for the trailing 12 months. a little bit higher, 8.3 for the forward price to book. And then the price to cash flow also too actually is not terrible. 11.95 for the forward price to cash flow. We would prefer this to be in the single digits, but this actually isn't too far outside of that and actually is lower than what I was anticipating to see. However, guys, Target's forward price to cash flow is currently 25% higher than its 5-year average price to cash flow, which isn't great, but it's also about 7% lower than the sector median price to cash flow. So I almost feel bad for mentioning it in the January 2022 best stocks video just because of its valuation. But to be fair, when I made that video, it really came down like even more in share price. You'll have to go and look at the exact number, but I'm pretty sure it was down like between 8 and 9% just in the last 30 days when I included it in that video. So from the time I made that video until now, guys, which really hasn't been that long a time, Target has really started to come back up in share price. Anyway, guys, now let's move on from the valuation and let's jump over to this profitability page. I want to take a look at the return on equity and the return on assets, as well as the return on total capital. Anyway, guys, starting with the return on equity, Target's is very high, currently at 50%, which is really good. This is 70% higher than the company's 5-year average return on equity and is also almost 200% higher than the sector median return on equity. And then moving on to the return on total capital, guys, currently sitting at 18.6%, which compared to the sector median and the 5-year average is very high. And then last but not least, the return on total assets, currently sitting at 12.46%, which also compared to the sector median and the 5-year average is very high, 109% higher than the sector median, then 55 or almost 56% higher than the 5-year average. So as far as profitability goes, Target is an A+. I mean, Seeking Alpha gives it an A+. It's looking really good. Now jumping over, let's go and take a look at some of the financials real quick, guys. And we're gonna kick things off here on the income statement, starting with the revenues. So across time, it looks like Target is kind of creeping up in revenue. It did really good between 2020 and 2021, had a huge jump in revenue, looks like a $15.5 billion jump in revenue just between 2020 and 2021. And then even in the trailing 12 months, which you can see right here, it's up another $10 billion in revenue. So really doing well as far as revenue growth goes. And it looks like the gross profit margin right here is sitting at about, right here, it's just over 30%. Here, it's maybe a little bit lower than 30%. So it looks like it sits somewhere between maybe 25 and 30% consistently, which is all good. As long as it's consistent, we can tell it's pretty consistent just from this right here. So, and then next, guys, let's jump over to the balance sheet real quick. I want to take a look at a couple things. We're going to look at the debt, how that's doing, and then we're going to take a look at the shares outstanding to see which direction that is moving in. So before we scroll down and take a look at that, guys, let's take a look at Target's cash on hand. And it looks like as the years go on, at least from 2019 until now, they've allocated a good amount of cash and equivalents. 2021 was a good year for cash, but it looks like they did spend a little bit between then and now, which is no big deal. Let's scroll down and see what the debt is looking like there, guys. So scrolling all the way down to the supplemental items here. So actually, let's look at the shares outstanding since it's here first. So this is looking to be trending in a great direction, going down. Target is doing a great job of buying back shares, guys. So this is what we like to see. I'm sure we'll see this continue in 2022. This is one of the many reasons I would love to add Target to my portfolio. They're just creating more shareholder value by buying back these shares. Additionally, guys, the tangible book value per share for Target is going up as well, which is really good. We're seeing this go up pretty consistently from 2017 until now, and it looks like it had a huge jump between 2020 and 2021. And even now, the last report, that's higher than where it was at in 2021. So it went up even more, which is great. And then taking a look at the net debt right here, guys, the debt really has come down since 2013. 2013, it was sitting at like 17 billion. Now we're sitting at a third of that, basically. And even from 2019 until now, they've done a great job of paying off debt. Basically, just in the last 2 years, they've cut that net debt down by half, which is great. I'd love to see this continue, guys, but it looks like the streak has ended because if we look right here at the last report, the debt is up by about $3 billion compared to where it was at the beginning of this year. So it did creep back up a little bit, but still lower than 2020 levels, still lower than 2019 and years before. So it's not too terribly bad and does seem to be manageable, especially considering the cash on hand. It looks like based on where their total debt is, which is about $15.5 billion, they could pay off about a third of that just with the cash on hand that they have, which isn't too bad. All right, guys, now jumping over to the cash flow right here, we are going to scroll down, take a look at the levered free cash flow. and levered free cash flow per share and see what those are doing. So levered free cash flow seems to be kind of sporadic, kind of all over the place, but has grown very nice since 2019. So 2019, 2020, 2021 were all great years for Target's free cash flow. Basically all of 2021 hasn't been too bad as well. I mean, this is where they were at the beginning of 2021, and this is where they're at in the last 12 months, or basically more recent. So that's not too terrible. And if we can see how much they paid in dividends right here, it looks like they paid just in the last 12 months about $1.5 billion in common and preferred dividends, and then the levered free cash flow is probably between 3 and 4 times that. So they're definitely able to cover the dividends. Not a big deal at all. That kind of points to the consistency and the reliability of the dividends for Target, which we could probably guess is pretty reliable because Target is a dividend king. And with that said, I want to scroll up now and take a look at the dividends just to show you guys what those dividend stats are looking like. So starting with the forward dividend yield, Target's is 1.55%, which is definitely on the lower end. That is one of the not so great things about investing in Target, is it does have a pretty low dividend yield, guys, but they do have some other good dividend stats to make up for that. Like, for example, they have a low payout ratio of 27.16%, which, like we saw on the cash flow statement a moment ago, they're not stressing about the dividend, guys. They have a lot of free cash flow, more than enough to cover the dividend. They can pay the dividend 3 times over and then some before they run out of cash flow. At least that's the case in the trailing 12 months. And hopefully that continues in years following. I'm sure it will. Moving on, they have a kind of an average 5-year growth rate. I'm not going to lie, 6.38%. Would love to see this a little bit higher, especially considering that the dividend yield is so low. But I guess there is a bit of a trade-off, guys. We do get a low payout ratio, and we also get 53 years of consecutive dividend growth, which, like I said a moment ago, Target is a dividend king. So we do get that reliability, we do get that security, but it does come at the expense of a lower 5-year growth rate and a lower dividend yield. And now that we've pretty much run through everything that we can with Target, from the share price performance to the financials to the valuation to the profitability to now the dividend stats, what I want to do now, guys, is jump over to the spreadsheet right here and take a look at the intrinsic value calculator. And just for the sake of time, I've already pretty much put in all the important data from the financial statements. I put in the cash flow for the last 5 years, put in the total debt, put in the cash on hand, and I also put in the shares outstanding. And it basically spit out what we're seeing right here so far. And just based on these numbers right here, Target has a 5-year free cash flow CAGR of 9%, which is something we could use right here. And just for this example, we'll put that in there right now, okay, guys? But the last component that we need to identify is the discount rate. So what margin of safety would we like to have if we're going to be investing in Target? Now, a very common number, I'd say on the low end, if you want to be conservative, is 8%. Some people even go as high as 10 or 12%. I think just for this example, guys, let's play with it a little bit, but I think we're going to start with 8%. And once we do, you'll see this number right here give us a final intrinsic value based on the metrics that we've put in so far. So starting with a discount rate of 8% and a free cash flow growth of 9% moving into the future, that gives Target an intrinsic value of $273.07, which means it's almost 15% undervalued based on its current share price, guys. So if your discount rate is 8% and you feel like that's conservative enough, and you're also confident that Target can continue to grow at a free cash flow growth rate of 9% every year, at least for the next few years, then you might be good buying it today. You might be good buying it at $232.85. But if you really want to be on the safe side and you really want to get it at more of a discount, what you're going to want to do is increase this discount rate a little bit. Now, me personally, guys, as I'm learning more and getting more involved with this stuff, I'm finding that I personally feel better using a more conservative number than 8%. I'd like to see what 10% looks like as a discount rate for this. And it's interesting to see, once we plug that in, how much different that makes the calculation. Now, the intrinsic value has gone from, $270 something to $191 per share. So using these numbers, guys, it means Target is still just a little bit overvalued. And this is kind of what I was talking about earlier in this video. I personally would love to see this stock under $200 per share. I think between 190 and 195 is a pretty good range. And that's me just being a little bit extra conservative in my calculation, and also having the confidence that Target can continue to grow at the same 5-year growth rate that it has been. But let's say that we're anticipating like a few not so great years coming up for Target. Maybe they're gonna grow at about half of the rate that they're currently growing at, which is another thing you can do to increase how conservative you are looking at these potential investments. Let's change the rate of free cash flow growth to 5% instead of 9% and see how that affects this intrinsic value calculation. So by making this change, guys, as you can see, it brought the intrinsic value down by quite a bit, by like $60 per share, which means that based on its current price, Target is now about 9.5% overvalued. Now, one thing I'd recommend to you guys out there who are making these intrinsic value calculations is to play with these numbers a little bit. Play with these two numbers right here and see how it affects the intrinsic value. I do think it is better to be on the more conservative side than to be more lenient, because you want to give yourself as much of a margin of safety as you can, because you never know what's going to happen in the future, guys. Target could perform better than this in the next 5, 6, 7 years, but it could also perform half as good. So I think it's good to account for any changes in performance this company might see. And obviously, guys, if you try and play it a little bit more conservative and buy it at a lower intrinsic value or calculated at a lower intrinsic value, it should mean that your upside potentially could be greater. And by doing so, you're also going to account for any unforeseeable negative years or not so great years in terms of performance from this company. So I just think all across the board, it's a good move to be more conservative when making these calculations. And sure, it has been growing by 9.02% in free cash flow for the last 5 years, but that's no indicator of the future. They could do worse, they could do better, and I think when making these calculations, you're better off assuming that they're going to do a little bit worse. So with all of this said, guys, and wrapping up our conversation on Target, what's the move? Is it a buy? Is it a pass? What should we do with Target right now? And me personally, guys, I wouldn't mind buying Target under $200 per share. I don't know when it will get there. I think stocks are pretty inflated in value still right now, and we'll see what 2022 brings. We never know what's going to happen, but I'd love to see some sort of correction, and if that comes, I would love to see Target get under $200 per share, and if it does, I'm pulling the trigger. That's my move, okay? You guys might be approaching this a little bit differently. That's totally fine, and if so, I'd be very curious to hear, like, what numbers are you coming up with for Target? What do you think a good price to buy into this company is? Let me know your thoughts on that in the comments below. All right, my friends, now with that behind us, we are going to transition into the Q&A segment of this video with the very first question coming from my friend Harothir on YouTube, who says, you mentioned that you aren't quite there yet on Allstate. I hear a lot of dividend investors use similar language, but nobody ever really explains what they mean by not quite there. What would Allstate have to do for you to immediately drop what you're doing and buy? What combination of factors do you consider a trigger point for buying a stock? Not just financials. That's a great question, and I'll try and answer all of those cohesively as I can. But the very first thing, when I say I'm not quite all there yet, it just means I need to think about it a little more, or I need to research it a little bit more. Maybe I need to spend more time with the financials, or really think longer about what Allstate's competitive advantage is over some of the other insurance companies in the space. Like, what separates Allstate from a company like Aflac or like Prudential? And while I think the financials look pretty good, the next frontier, I think, is, for me at least, when it comes to analyzing these stocks, is identifying that competitive advantage. That's such a big component to investing in these stocks, especially if you're trying to choose them for the long term. And that makes me think, from when I first started dividend investing to now, the way I'm approaching investing in these stocks is so different. I'm trying to take it to more depth and really spend more time with these stocks before I pull the trigger on them. That's why I'm having such a hard time buying Citigroup. I really want to, but I just don't feel like I know enough about it quite yet. Just like with Allstate, I'm not quite there yet. And for me, the missing component to both of those, like I said, is identifying the competitive advantage, if there is one. In Citigroup's case, like, what makes Citigroup different from a company like Bank of America or JP Morgan? Why does it stand out from other companies like those, or Wells Fargo even, These are things that I'm now thinking about with these companies that maybe I wasn't earlier on in my journey. And to answer the second part of this question, what would Allstate have to do for you to immediately drop what you're doing and buy? I don't know if it has to do anything. Really, the holdup is on my end. So that's my 2 cents on the matter. Harothir, hopefully that answers your question. Thank you so much for asking. Now let's move on to the second question of the day, which comes from USANDI98, who is in the Dividenders Discord server, who wants to know, hey guys, so I've been analyzing some financials, but I have a question that pops every time. When I see the EPS, which is earnings per share, and this going higher, how do I know if it's because the company is buying back shares or just because the way the company is evolving? I mean, I tend to buy companies that buy back shares, but how do I identify the main reason of the earnings per share go up because of this? Maybe it's a dumb question, but the answer doesn't pop in my head. Honestly, that's a really great question, and there's a couple different ways that you can approach this. I mean, first of all, if you think it could be due to them buying back shares, go and look. Go and see if the company is buying back shares. But also, a company's earnings per share could be going up consistently because they're consistently increasing their net income. And that's another thing that you can look at. Go take a look at the income statement and see what direction is this company's net income going across time. Is it going up? It's going down. And I think you can look at both of these things to determine what the root cause is for the earnings per share growth. Hopefully that answers your question, and that was a really good one. Thank you so much for asking. And with that said, guys, that wraps it up for today's video. But I want to thank you so much for watching and spending this time with me. I really appreciate all of your support on these videos. You guys are just awesome. So good at liking these videos, so good at commenting. We just have a really strong community of investors on this channel, and I'm really thankful for that. With that said, if you guys haven't done so already, please don't forget to leave a like. Leave a thumbs up before you click on to the next video. And also, leave me a comment below. What do you guys think about Target? I want to know your thoughts on TGT, okay? Leave them for me in the comments below. Last thing, guys, I know I just mentioned it like 30 seconds ago, but I'd like to invite you to join the Dividenders Discord server. For those of you who don't know what Discord is, basically it's just a platform where we have a big group chat of other dividend investors. And at this point, we're up to 300 members in that community, 300 members on the Discord. All we're doing is getting together and talking dividend stocks and sharing our portfolios and talking about dividend income and retiring early and all that fun stuff. So if you'd be interested in taking part in any of that, guys, the link to join the Discord is in the description. Totally free to join. All you need to do is click the link. It'll open up the link to the Discord, and you just read the rules, click the green check mark, and you will get access to all of the chats. There's like maybe 15 or 20 different conversations going at any given time. So a lot of good stuff going there. Anyway, with that said, I will now get out of your guys' hair, but thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.